to get the details of these figures. At the bottom here, we've got our surplus or deficit. You can call it either a profit or a loss. As you can see, in 2007, we were at a net deficit of 181 billion. We progressed on through the years that were coming on. In 2011, we had another deficit of 387 million. We have a statement of financial position. This is again in summary. You have this right in front of you. If you cannot see what is there, it's exactly what is on Appendix A. This, you can call this a balance sheet, if that's what will make it easier for you to be able to understand what we are talking about. So our statement of financial positions starts with our fixed assets on top there, which are broken down. In our situation, in this union, we've got two components that are making up our fixed assets figures there. We've got our tangible assets, we've got our investments there. As you can see, this line here for investments, these are the shares that we had earlier alluded to in WDC and Puma. On top here, we've got our fixed assets. This includes land, buildings, it includes our computers, it includes our motor vehicles. At the bottom here, we've got current assets, which constitutes our debtors, our staff debtors, and our bank balances. These are all running on a comparative note. The bottom here, where we've got these two double lines, that shows our net balances in terms of our total assets. You can see in 2007, we were only at 664 million. We have since graduated and moved on to 2.4 billion in 2012, meaning our balance sheet, yes indeed, it has been growing with time. It's an exponential growth that we can see running through the years, meaning as a union, we have been acquiring assets. We have been investing, meaning we are progressive because we are moving forward, we are growing, and we are sound. The next slide I'm showing you here is capturing our liabilities. Our liabilities made up of our overdrafts, our creditors, and accruals on a comparative basis. As you can see, we started at 280 million. We are moving through the years. We were still graduating up to about 1 billion in 2012. These activities, as we had heard in the General Secretary's report, there were so many activities that were undertaken. These activities are supported by finance to make it possible. We were financed by these two columns, our accumulated fund, which accumulates moving on year-on basis. We've got our evaluation reserves there. We also have our loan components. On a comparative basis, looking at the figures that we have, there is graduation, progression year in and year out. We've got our evaluation reserves. If you note, through the time under review here, our evaluation reserves have not been revalued over time. There are accounting principles or accounting adjustments that you need to do, and it's not year in or year out that we need to make these revaluations. Like I mentioned, there are standards that govern how we come up with such a set of accounts. At the bottom here, we've got our total liabilities, which, if you look at the sheet that you have there, are balancing with our total assets that we have, meaning our accounts are balancing. So we move on from the comparative model that we have here We are now going to go into these accounts on a year-on basis, starting with 2007, 2008, right up to 2012. You've got the full details in your files, and I hope people took time to look at these accounts so that we do understand them.
And yes, maybe before we proceed, I've seen a hand. So,
thanks, Chairman. I want to make a proposal to the House. Considering that we are looking at financials, and believe me, the moment we start from 2007 going to 2012, will actually sleep here. So my proposal is that, because we also need to reserve energies and understand, digest this information. So my proposal is that we look at 2010 going forward. It is just a proposal, because we've seen the programs overlap into another day. So, and then tomorrow the program is quite tight and close. So just a concept.
So meaning, in short, we skip off 2007, 2008, and 2009?
It's a proposal.
It's a proposal.
What my colleague has spoken, maybe we can start from 2012. The current year.
What is the House saying?
Yes.
There. Then we go to. There are two proposals.
Moving on, we are going to be reviewing the 2007 accounts. So our 2007 accounts, if we go to the 2007 accounts on page 3, within your folders, within the files that you have, we've got a summation of what transpired or where these figures are actually coming from on a comparative basis. At the last conference, the last adopted accounts were for 2006. The income was at 1,999,309.43. In 2007, it came to 2,288,657,694, which gave us an incremental variance of 289,348,651. Our revenue is denoted by note number 3 in our accounts. What is note number 3 saying? If we go to note number 3 within our accounts, note number 3 is on page 8. Page 8 tells us that the revenue or the income, this is represented by subscriptions received from union members during the year. These are the 2% that we have been talking about, or the 2% which people are saying there is always this question that the 2%, where's the 2% going to? If you go down through our accounts, page 10, after page 10, we've got an appendix, appendix 1. You go to appendix 1. After appendix 1, you find appendix 2.
Do you have any problem? What document are we referring to?
The 2007
Which
account.
one? There are two folders.
No. The main folder.
The main folder, yes.
The main folder
So let's
that
get to
you
the
got.
main folder.
The main folder that you got. Let's get one thing straight. There are two folders. There's a box file. The box file contains detailed accounts. The report by the acting Assistant General Secretary Finance contains summation. So what are we saying? We are saying we are looking at the summarized figures. What is making up that is the subscriptions. what is making up the expenditure. There's a breakdown for all these figures. These figures are not just simply lumped there. They come from somewhere. Income is denoted by Note 3. And under Note 3 was simply telling us that this income comes from our member subscriptions. Those subscriptions, the page I was trying to drive you to, is for us to be able to see the member institutions that contribute towards union subscriptions, where this figure is coming from. All the institutions that we are representing here did contribute a 2% for each and every member, which were then summed and they make up that figure. Are we together? Yes. Are we there? In the main quarter. Fine. Can we start again? We go back to page 3 under the accounts of 2007. Page 3 of the 2007 accounts. We are using this kind of a presentation that is shown here, starting with operating activities. This is called an indirect method. There are two methods, a direct or an indirect. We are using an indirect method. So we start with our operating activities. We start with our opening balance there, which is the deficit. That came from our profit and loss or our income statement, which is 181,732,000. We are subtracting the interest received because this interest is not part of our operating activities. So when we report in our cash flow statement, we need to get rid of that because it's not an operating activity. Our prior year adjustments have also been removed there. We are adding back depreciation of 13,996,000. We have a profit on disposal there. We were looking at our assets where we had our land, motor vehicles, and so forth, where we have a column that takes care of disposals and acquisitions or additions. We are removing that figure as well from there because it's not our major operating activity. We have a depreciation figure there that is being added. So giving us our operating deficit of 145,500,141. Then we've got a decrease in our debtors there, which is 1,635,984,000. We have an increase in our creditors, which is 555,650,345. Our net cash outflow from the operating activities, as itemized, comes to 88,213,812 is in brackets. That's a negative figure. Our net cash flow from operating activities is brought down there. It is in bold. Then we have our returns on investment and servicing of finance. We are adding back the interest because at this point it has to be added back there under that column and under that heading. We also have investing activities. We have capital expenditure there. We have proceeds from sale of the vehicle. We have capital adjustments there, giving us our net cash outflow from investing, which is 134,911,8 a quarter.